Welcome back to our intermediate financial accounting class. Over the last few segments, we've been building a balance sheet and talking about the importance of the balance sheet, and then building a statement of cash flows and talking about the importance of the statement of cash flows. In our last segment, we finished up our worksheet and all of the different changes in cash, and we talked about the difference between a direct and indirect style statement of cash flows. Now, since by default most companies do the indirect method, we're going to go ahead and focus on that one throughout our discussions in this course. So let's go ahead and build an indirect statement of cash flows so that we can see how it comes together. And you'll find a template for it right down here, starting in row 52. So what we're going to do is we're going to start with net income and turn it into cash flow from operations. I'm going to type these in so that I don't have to scroll back and forth and make it look confusing. If you want to link them, by all means, please do. So net income is $263,556. We can get that either from the worksheet or back from the income statement. And then I'm going to make a series of adjustments. So I'm going to start with the change in accounts receivable net, and that was a negative 50,000. And again, I repeat, I'm typing them just so we don't have to scroll back and forth. I actually really recommend that you link them. Next, we have the, this should be the, I'm typing cash. I got cash on the brain. Should be change in accounts receivable net. Change in unearned revenue, positive 20,000. Change in inventory, change in accounts payable, negative 43,556. Change in wages payable. You'll notice I'm just going right down the worksheet. Depreciation. And you notice I don't put a change here because I don't care about the change. I'm just getting rid of a non-cash item. So I'm just going to add in the 40,000 so that we get depreciation out of there. Change in prepaid insurance, change in prepaid rent, change in income tax payable. You either need to add a net adjustments line, or right here to the right of this big long list, you can just calculate the sum of all of these adjustments. There's my net effect. And if we go up and take a look, there's our 290 right up here. There's the 290 right down here. So that's the first part of our statement of cash flows, a cash flow from operating section that follows the indirect format. Now the good news is cash flow from investments, cash flow from financing, that stays the same whether you do indirect or direct. So let's go take a look. Investing, remember, is the purchase and sale of long-term assets. So it's going to be this section of the balance sheet that gets included in cash flow from investing activities. And you can see we've only got two. We purchased some land and we purchased some equipment. So I'm going to come down here and put cash paid. I'm going to try to put cash paid for land, and cash paid for equipment. And there's my cash flow from investing activities or from investments, either way. The exact titles here are up to the company. I've got net cash flow from investments, but it could be cash from investing activities as well. Depends on the company. One other thing, before we move on any further, let me just mention up here, you'll notice we put in these changes in accounts receivable, change in accounts receivable, change in accounts payable, change in wages payable. Really, if you're doing a formal statement, you wouldn't call it the change. You'd call this the increase in accounts receivable net, and this would be the increase in unearned revenue, and this would be the the decrease in inventory, etc. We went through it kind of fast, so we just used change, but a formal statement would include the direction of the change so that it looked a little bit better. Let's take a look then at our cash flow from financing activities. And again, these are the repayment of our long-term debt and any payments from or to our owners. So that's this section of our balance sheet, and we have three items. We've got the amount of the loan that we paid off, we've got the note that we took out, and then we talked last time about the dividends that we must have paid, because we've got it right here in our statement of retained earnings, $50,000 dividends, and there's no dividends payable, so I must have paid them all. So let's put this in here then. Again, if you want to link it, please do. I'm going to type it so I don't have to jiggle around the screen so much. Cash paid on loan balance, or something like that. Could be cash paid to repay loan, cash payment on loan works too. That's a payment, so it's a negative. Cash received from issuing, let's see, from note issuance, or from issuing note, that works too, either way. And cash paid as dividends. And again, that $50,000 comes right from our statement of retained earnings. Now the moment of truth. We've got our investing section done, we've got our financing section done, we've got our operating section done. It's all put together and done, and hopefully it'll balance out. And remember, we had a check figure up here. Our net change in cash is this $30,000 right up here. So that's what I need to get down here. My net increase or decrease of cash better match up with that $30,000. So I'm going to take the operating plus the investing plus the financing, $30,000. I match up. Now, a lot of people just learning the statement of cash flows like to stop there. Hey, this balances, I'm good to go. But that's not the end of the statement of cash flow. Statement of cash flow, like every financial statement, has to balance with something. Balance sheet balances assets, liabilities, and equity. There's a balance. Statement of cash flow has to balance with your cash balance on the balance sheet. So if I stop here, I don't balance. I'm not done. I have to add two more line items. One is the cash from January 1, which I get from my balance sheet, right at the very top, this $100,000. And then I'm going to add those two together, the $30,000 plus the $100,000. There's my 70. I know it'll balance because I already checked the 30,000, but always double check. That 70 should match this 70. And it does. Whew. Thank goodness. It all comes together. That's what we're looking for in a statement of cash flows. Now again, once you've done the other statements, it takes a few minutes, but a statement of cash flows really can be very intuitive if you think about your teeter-totter and your wave. You'll be good to go. Let's take just a couple minutes now that we've finished a US GAAP statement of cash flow, and let's talk briefly about an IFRS statement of cash flows. So I'm going to go back here to my PowerPoint slide so we can go through this. First, couple of minor differences. Companies have to report their bank overdrafts as part of their cash and cash equivalents balance on their statement of cash flows. You also have to include it on your balance sheet. You might have noticed that when we did our statement of position. So you have to include that there. In addition, you have to break out your interest, your dividends, and your taxes. You can't just show a change in income tax payable or a change in interest payable. You have to show cash paid as interest, cash paid as taxes. So those line items have to be shown as cash paid. In addition, the IFRS statement of cash flow allows some flexibility that we don't have under US GAAP. So interest revenue can be either operating or investing. Interest expense can be operating or financing. Dividend revenue can be either operating or investing. Dividends paid can be operating or financing. You have flexibility. Except for dividends paid, all of those other three show up as operating under US GAAP. It's required. So we have to have them there. Under IFRS, we've got a choice. Taxes, we have a choice on that one too. Again, you have to show cash paid as taxes, but you can break it down. You can do cash paid for taxes for operating activities, cash paid for taxes for investing activities, cash paid for taxes financing activities, or in operating, just cash flow from taxes. So you've got a choice, but you still have to show the cash paid. And the three of them have to add up to be the total amount your company paid in taxes. The other rule here, You have this flexibility, but once you make a choice, you're stuck with that choice. You have to stick with it. Now, the last part of this, once we have all of our financial statements done, we can do some analysis. And that's what we want to talk about as we wrap up this section. Our 3 ratios, one with a couple of variations, that allow us to do some assessment of our financial statements. So the first is the current ratio. Other than earnings per share, perhaps the most common ratio used. Current ratio is a measure of short-term liquidity. Can we handle our short-term debt with the short-term or current assets that we've got? Traditionally, we've said that it should be a little above 2, but now we've started to pull back from that and say, you know, it really should be between 1 and 2. You need at least 1 so that you can pay off all of your current liabilities. But once you get to 2 and above, man, can't you find something better to do than have so many current assets? Maybe you can invest in something else and maybe make more profit by investing some of those current assets a little bit better. So now the rule of thumb is between 1 and 2. You will see some industries where it's all above 2, primarily because they need a lot of cash on hand all the time. Like banks, they've got some funky rules here or funky patterns. And then you've got companies like Walmart that are just different. Walmart's current ratio has been well below 1 for a long time, but they're Walmart and they churn through stuff so fast, they've always got plenty of cash. So it depends on the business and its competitors. So it's something to look at. Basic equation, we take current assets and we divide by current liabilities, and that's it. Pretty straightforward. The next one that we want to talk about is our cash flow to current liabilities ratio. Now this is another ratio of risk. How risky is our business? This time, instead of liquidity, short-term stuff, we're talking solvency. Can we handle our long-term obligations? So to do this, we're going to take our cash flow from operating activities or from operations. We're going to divide that by our average current liabilities. Now this is another ratio that has a lot of different options. You see a lot of companies, a lot of analysts doing it different ways. So you can have operating on top and total liabilities on the bottom, or operating on top and just long-term debt on the bottom, or like we've got it here, current liabilities on the bottom. It depends on the analyst and what that analyst is really trying to capture, but for our discussion, we're going to keep it this way. But just be aware, lots of different options for this one. The basic rule of thumb here, there's no specific range. It's just bigger is usually considered less risky, although then there's the question of, well, why aren't you leveraging a little bit more as that number gets too high? So there's some flexibility there. The next one then is really one ratio, but we can do it 2 different ways. This is a profitability ratio. ROA and ROE, same basic idea. It's how much profit are we making on our assets or on our equity. Either way. So we take net income and divide by average total assets, or net income minus preferred stock dividends. So we get out the dividends that go to the preferred stockholders that don't really have a vote. So we just get what's left over for the common stockholders. If you don't have any preferred stock, you just make that part 0. So you have net income minus 0. So we take net income minus preferred stock and we divide by average total equity. And that average total equity then gives us the amount that we're making for our owners instead of just overall on our assets. So rule of thumb here, we want it to be as big as possible because that means we're doing the best we can with our assets and with the equity number. The other rule of thumb with this one is that the return on equity should be much higher. Well, maybe not much higher, but it should be higher than our total assets. How much higher will depend on the industry that you're in. Now, because we're running a little bit long here, we're not going to take time to actually calculate these ratios. I wish we could, but we got to cut somewhere so that we make sure we get this done in a reasonable amount of time. So let me just give you a couple values. Your current ratio, if you were to calculate this for CBDS, should be 2.7. So theirs is a little high based on our rule of thumb. Cash flow to current liabilities, 1.46, perhaps a little low. ROA should be 0.213. So for every $1 of assets, we make about 21 cents in income. ROE should be 0.35 or 0.346. So for every dollar of equity, we're getting about 35 cents in profit, which at least it follows our basic rule of thumb that ROE is higher than ROA, which is what we want. Whew, lots of information here, isn't there? There's just so much going on in these statements, so much information that they provide. Before we end, I want to talk about one last thing with our statement of cash flow, and that is the fact that our statement of cash flow provides us not only with cash flow information, but also signals where our company is within its life cycle. You remember the life cycle of a company. We start with beginning or startup, then we move to growth, and then we move to maturity and then decline. Our statement of cash flows really does mirror this. In a in a startup company, we're usually losing money. So cash flow from operations is negative. Cash flow from investing is negative as we're trying to grow and build the company. Cash flow from cash flow from financing is very positive because we're getting all of our money from investors. As we move into growth, cash flow from operations switches. It's still small, but we have cash flow from operations positive. Still very negative in investing as I'm starting to grow my business, and still a lot of money coming in from our investors, so cash flow from financing is also positive. As I move into maturity, now things switch. I now have lots of money coming in from operations, tons of it coming in. Enough that I am paying for all of my investing, which is still negative, but I'm paying for all of that with my operations, and I'm starting to repay my owners. So I'm starting to repay debt, I'm paying back a lot of dividends, so I see a negative value for the first time in my cash flow from financing. In decline, might have positive cash flow from operations, but as my business is dying, it's starting to get small, if not negative. Cash flow from cash flow from financing, positive or negative, that one depends because, could be that our investors are trying to save us, could be that they're wanting their money back through a liquidation. So that's up in the air. But the real thing that shows a decline company is the fact that its cash flow from investing for the first time is positive. We're selling off assets because we just don't have anything to do with them, or we're trying to save ourselves by selling off those assets. There's just so much information here. Life cycle of the firm, ratios, financial data that's all wrapped up in the balance sheet versus the statement of cash flow versus the income statement. So much going on. And remember that here we're just summarizing all of the stuff that's happened through the accounting cycle with these 4 pieces of paper. We're trying to convey an entire business in 4 pieces of paper. Everything that's gone on in the period. That's a lot. But now that you know how to build them, you should be comfortable in at least understanding where that information comes from, what it means, how it all ties together. What we really need to do now, though, is start delving into some of the important transactions and big pieces that maybe aren't as intuitive. And that's where we're headed from here. We're going to zoom in and talk about the different assets of the company and how to account for them in more detail, and then the liabilities and equity, and what we can do with those numbers so that we understand them better, and what kind of transactions go on in each category. And once we've done all of that, then you'll really feel comfortable with what's going on in the financials. So, stay tuned.